Yeah, thanks so much, guys. So much happening in Fireside at the moment. We've got more panelists coming on board in the last week. Paul, Bobby, we we've got a lawyer joining the team soon. So much happening at Fireside, so we can help everyone with just about anything, which is really exciting times. So, of course, these webinars are fantastic to address specific issues. So, thanks so much to Tim for joining us tonight to discuss responding to the budget. Yeah, and thanks, Bobby, for MC.
No worries at all. Absolutely, my pleasure. All right, Adam. Well, we'll probably say goodbye to you for now, and Tim and I will take it from here. All right. So, quick introduction for Tim. So, Tim is the lead for the Readyone Group, which is a Melbourne-based business and tax advisory firm. So, the firm was established as a boutique practice that provides commercially focused expertise while maintaining a highly personalised, relationship-driven approach. And in my conversations and getting to know Tim here at Business Advice, I can absolutely attest to that. So, Tim, do you want to give us just a really brief overview, perhaps, of yourself and how we're going to position this tonight for the viewers?
Yeah, thanks for the intro, Bobby. Yeah, so as Bobby said, accounting firm in Melbourne, we've been going for about 8 years. We started basically from scratch, and we just built it up through service and referrals and word of mouth, things like that. And yeah, so we started just before COVID. COVID made us really busy. We got in the trenches during COVID. We got out of that, and it sort of hasn't been smooth sailing since we started, unfortunately for a lot of people. But yeah, here we are again with some tax changes that look like they will change the landscape for a lot of business owners.
Yeah, absolutely. And there's a lot of discussion out there in all channels about it, and I think that there's people are popping out of the woodwork, all with their own perspectives. There's people on either side of politics taking a position and trying to frame this up, whether it's in a good light or a bad light. But today, I haven't seen any hard facts, so hopefully we can get to the bottom of that today, Tim. Mate, do you want to give us just maybe a bit of a perspective on the potential legislation that's coming through and what the impact of that would be?
Yeah, so you'd probably be nearly living under a rock if you haven't heard anything about the proposed changes, and that's all they are at the moment is proposals. Yep. So we haven't got some definite rules. There's three major things. So the first one is negative gearing for investment properties. The government are making some drastic changes there in terms of buying properties and not being able to claim the losses against them on other income. The second thing is capital gains tax. Again, there's some major changes with that that are coming into play, and the tax consequences on that are going to be drastic. And the third thing, which has been the most controversial one, is changes in tax law legislation, trust laws. So there's going to be a minimum rate of tax on trust distributions, and they're also doing things like basically not allowing you to use bucket companies anymore because it'd be double taxation, so people just won't do it. As I said before, at the moment, they're purely just announcements. The negative gearing changes and the capital tax changes have been introduced to Parliament, so we have some idea around what the rules will be, but there's still some negotiation on that. With the trust law changes, we've still got some time before we see some legislation, and I don't think we'll see any legislation until later in the year or early next year. And the amount of, I guess, noise about Labor at the moment, they might do a backflip. There's been announcements in the past that haven't gone through, so time will tell, I guess.
Yeah, they're still going to try and stay in government, which I think is number one. Okay, so if we zoom out a little bit, what do you think the government is actually trying to achieve? They've got a constituents, and they've got essentially the broader demographic of Australians in mind. That's how they project this. What are they trying to do?
I mean, with the capital gains tax and negative gearing changes, their commentary is that they're trying to make housing more affordable. But from what I've experienced in the last few weeks, a lot of new entrants into the market will do what's called rent vesting. So they will rent where they want to live and invest where they can afford to buy. So, for example, young professionals in Sydney, they cannot buy a house there because the prices are so substantial. So they would typically buy in an area in Australia they can't afford and rent there and thereby hopefully get some capital gains on those investment properties to allow them to get into the market in the future. So they can no longer do that because it's unaffordable for them to hold an investment property because they can't claim the negative gearing against their income, right?
Yeah.
So there's that, and then with the trust law changes, these are for me really controversial because they're affecting people that basically split income to people with low incomes. So the two common examples we see with the trust laws are, first of all, you'll have a young family and one parent decides to stay at home full time, and the other one will start up a business to give them the flexibility. So in a typical example, they might be earning 100, 150 grand as a family, splitting that income two ways, thereby reducing tax. Whereas now, the first 45 grand is a minimum of 30% tax. So there's additional tax payable on that scenario if you do nothing. And the other example is your self-funded retiree that have money in a trust and they distribute their income. Now they're saying there's going to be a minimum tax of 30% on those distributions. So it makes it harder for them as well. I think their argument is someone that's earning 150 grand as a wage should pay the same amount of tax as someone earning 150 grand running a business. But my view is running a business is a lot more riskier than rocking up to work every day and getting paid a wage because you're taking on risks of a business, you're putting yourself on the line, and as we know in business, things can go wrong. So for me, it's a punishment against those people, but yeah, there's still ways we can get around these rules once they're implemented. We just have to be smart about the restructuring, and there'll also be, well, they said there's going to be revisions to restructure. So my views are, depending on your circumstance, now everyone's different, and everyone's circumstance should be looked at separately as an individual, but there's going to be ways around it. We just need to work out what the best way forward is given someone's circumstances and position.
Yeah, I understand. And so you touched on it there a little around people's ability to invest and the appetite for investment within the market. Can you drill into that piece just a little bit more? Because from what I've heard, there's already impacts on, say, the property market. I think there could be a broader economic impact of an unwillingness to invest as a result of the lack of incentive to do so. How do you think that's going to affect people's investment decisions or capital formation, as a result?
Yeah, good question. So from what I've experienced the last few weeks is there's two types of investors that are really affected with this. There's, your average punter, mum and dad, and I'm finding that people that were going to invest are just waiting to see what happens. And I think everyone's doing the same thing. So that means property sales will take a hit for a while. So like the government's goal is to reduce property prices. So I think for the short term it will, but for the medium to long term, we've still got more demand on properties than supply. So basic economics will tell you that properties will go up, and this is just a sort of short term fix. I've read some articles that potentially we might see a 10% correction, but over the last 10, 20 years, the growth in property has been significant. So it's just like any other investment. You hold over the long term and you seem to get in front, shares or property or whatever it is. So there's that end of town. And the other end of town I've seen is very wealthy Australians looking at investing overseas now in the US market. So taking their money out of the country and investing it elsewhere because of what's going on. Now, you can imagine what that's going to do for our economy and the way things are ran. So, yeah, they're the two ends I'm seeing. People looking at getting into the market are sort of sitting back and waiting. And people with a lot of wealth are saying, well, I'm not confident in this country anymore. I'm seriously looking to invest maybe in the US or overseas somewhere.
Okay, understood. That's good. That's a really good sort of broader macro economic perspective. So should we drill down into trusts? And if say, because we have a lot of business owners and operators within our cohort here. If anybody's got a trust in place at the moment, they're probably wondering what the impact of this is going to be. What should they be doing?
Good question. So we've still got a heap of time until this goes through. So the trust law changes won't happen until, if they go through, the 1st of July 2028. So that's 2 years away. During those before that comes into play, a few things have to happen. The legislation needs to go through, and then we're due for an election in the first half of 2028. So we don't know what the opposition's position is. Are they going to come out and say, if you elect us, we'll reverse it? We don't know. So for me, it's people in business with trust at the moment. It's business as usual. You might see on socials, a lot of people are saying, oh, this is how you get around it. This is how you should structure. This is how you should change. But at the moment, we don't exactly know what the rules are. So my view is business as usual. We've got time. So no need to panic or change anything. Let's just see what these rules are and if they actually happen. And if they do, then we'll say, well, what's the best course of action from here? If they do go through, you might need a restructure. But in an example where you've got, as I used before, a business, mum and dad business with 150 grand profit, if they're actually both working the business, all you need to do is replace your distributions with wages. So you pay yourself a wage. As long as it's reasonable and it's market value, then we get around the minimum tax rules. So again, there will be ways to get around these rules. It's just a matter of assessing, well, what's the best way to do it. So it's a bit boring, but yeah, at the moment it's just business as usual, and just we could see what happens and assess the position once it comes out.
Yeah, I fully agree with you. I think there's a lot of smoke and mirrors at the moment. Like any budget, the government's pushed it out there to see what A would be, potentially any of the pitfalls, or they might patch them up before they move forward. But with that in mind, what are some of the perhaps misconceptions or something you've seen in the media or perhaps on socials that is just complete bollocks that you can you maybe give us a bit of a layman's perspective on it?
Yeah, I mean, one thing I've seen, like scaremongering articles saying, oh, the property price are crashing. The US bank come out and said, oh, they're going to go down by 10%, which is a crash apparently. So there's a bit of those scaremongering sort of articles, clickbait going around that I've seen.
Yeah.
And as I said before, I've seen some people spruiking that you have to change your structure now. That's not the case. So business as usual, as well as there's been a few things about negative gearing and whatnot, changing your properties. But again, if you've got a property and you're looking at doing a change, you need to get advice. So my advice would be, don't act on an article you've seen. Speak to an accountant, speak to your accountant and say, well, this is what I'm looking at doing. What's the best way forward? There are a few clever things you can do, like making sure that with the negative gearing, if you have an existing property, you can still use negative gearing in that property. If you buy a new property, you can't. So the goal is, in that instance, is if you buy another property, is to keep the existing property debt as high as possible. Do not pay it off and pay other debt down. So little things like that you can do. But again, there's been a lot of panic about what's gone on, which we can't control the narrative of what's going to happen. It's just making a calculated assessment of what the best way forward for people, basically.
Yeah, I fully understand. And with that in mind, is there potential benefits out there for businesses? I mean, is there any, silver lining for the cloud when it comes to perhaps different size businesses or different structures? Can this help some people?
I mean, it's a good opportunity to look at your structure because you might have started a business 5 years ago and for some reason your structure is no longer appropriate. So the typical thing someone would do is start up a family trust to start business in. But with family trust, there's no fixed entitlement to it. And this is what the government doesn't like. So the Labor's issue with trusts they're kind of like the Rolls-Royce structures for accountants. It gives you the asset protection that you need, but it also gives you flexibility to basically distribute money to anyone in your family, any structures controlled within your family group. So there's all this flexibility which the government don't like, because 1 year I can distribute to Bobby and then the next year I can distribute to Bobby's auntie if I wanted to. So that's what they don't like. There's a lot of flexibility around it. So again, it's an opportunity to go, well, is this structure suitable? What's the plan for my business? Do I want to sell it? Do I want to give some of it to my employees or offer it some to my employees? So maybe we need to restructure to a company anyway. Are we paying too much tax? All these separate things we look at and say, well, yeah, there probably are some opportunities, especially if the legislation allows us the opportunity to restructure into something else because of the law changes. So yeah, it could actually work out well for some people.
Understood. Okay. Yeah. Yeah. In other words, productivity can come from change, or it may potentially force some business owners to have a look at the way that they're structured. And in that case, they might find advantages elsewhere. What about new business owners? So, say I was gearing up to invest in some equipment, or potentially hire my first couple of staff. Is there anything that I need to be wary of as a result of this? I'm sure for new business owners, it would be causing probably a bit of grief, because not only is it not clear, the potential ramifications of different structures aren't really laid out yet. So, is there any advice you could give to the guys who are starting up?
Yeah, good question. So for me, we stick to what we know and what the current rules are, but we also need to work with the new rules in mind. So really, these rules only affect people who have someone to distribute that's under 45 grand of income. So for a lot of businesses, it actually won't impact them, because they don't have people in those brackets we can distribute to. So for new businesses, we really say, well, what's the goal for the business? Have we got anyone under 45k we can distribute to? If it is there an ability for them to work in the business? If it isn't, well, maybe a trust isn't the best structure and we go down a company route. We also need to consider the risk involved in what the person's doing. So, a marketing consultant doesn't have as much risk as an electrician would, for example, in the business of something going wrong. So, trust offer an awesome amount of asset protection. They're great. But if we don't need that asset protection, maybe it's a company with different shareholders. But again, it's sort of up to, well, what's the client doing? What are they going to do in the business? What's going outside the business? And how do we best protect everything they've got and minimize tax as well? So there's no, one straight structure that should be appropriate for everyone. It's dependent on their circumstances.
Understood.
So I guess it's important that when they start, they get that advice from a trusted advisor to say, well, this is what I'm doing. What's the best structure? Not just go, oh, I'm going to set up a trust because my mate down the street told me it's the best thing.
Yeah, which I'm sure a lot of people would do. Hey, so with that in mind, if say a business owner gets some advice and there's a total restructure in regard to the way they're set up that could potentially benefit them, what does that look like from the business owner's perspective? Can you walk us through what a restructure would look like and how that is facilitated?
Yeah. So one particular scenario to work well is, at the moment we see a lot of businesses ran through family trust, right? And we typically do tax planning and say you've got a really good year of income. If we distribute it all through yourself, it might be one person involved. You're going to pay tax at 47%, right? Which is not ideal. So in that instance, we'll consider setting up what's called a bucket company, and we distribute the profits from the trust to the bucket company, and we pay 25% tax in that example. So with the new rules, they're taking that away from us. So we then say, well, if that's not going to be appropriate for you anymore, we actually need to get the business into the corporate environment. And if it's making that kind of money, then it probably makes sense, because with a trust, you have to distribute the profits out.
Yep.
But in a company, you've got a choice. So you might say, well, let's set up a company with a holding company, for example, and we can take all the profits out and sit it in the company. Whereas in the current scenario, it gets a bit messy because you've got bucket companies over here. So yeah, there are some opportunities to restructure in that kind of manner as well.
Yeah, understood. And so say I'm trying to progressively to the demographics that I can think of that this can impact. Say I'm perhaps coming to the end of my business ownership life, and I'm thinking about retiring maybe in the next 5 or 10 years. Is there something that they can do, or what would be the impact of these potential changes for those business owners who've been at it for a while?
I mean, this one's a massive change, and it's a great question, because a lot of people will say, "Yeah, I'm going to work my ass off for 15 years or 20 years, and then I'll have an asset that I can sell and retire on," right? And then that final piece is where a lot of people get stuck, because they might say, "Well, you've got all this tax to pay on the sale of the business. What are you talking about?" So there's all these concessions, but you need to qualify for those concessions, right? So with the proposed capital gains tax changes, at the moment, there's a few discounts we use, but everyone gets what's called the 12-month, or except if you're in a company, 12-month 50% discount. So that means you automatically only pay tax on half of the gain when you have a capital gain. With the new proposed way, it's indexation. So your asset goes up by inflation every year. And if you start a business, you don't have a cost. So you don't inflation on zero is 0%. So you pay tax on the full gain, right? So it's important that we look at the structure. But with the new changes, I did a scenario. You will have, if you have a $2 million gain, with the current rules, no tax, right? With the new rules, there's probably about at least 100 grand in tax with the new rules in that example. So if the game is to build something to retire on, it's again making sure we qualify for those concessions or those small business concessions, whilst not paying too much tax along the way. So
Yep.
it's a bit tricky, and it does make it a bit trickier with the new capital gains tax rules. But it's more just saying, if you're looking at selling in the future, what's the best way we can do this in terms of the structure for now and the later end sale.
Yeah, understood. All right. So this has been probably, we'll call this the first section of the chat. What I thought I might do is go to the guys to see if there's any questions, just to see if we can put you to the test, Tim, to be honest. So let's see if we can get some questions for the guys. Adam, I think you probably got a little bit more visibility on the chat there than us.
Yep, I've just messaged everyone. Nothing imminent. So we all know everything about all of the change.
Well, I mean, I must admit, Tim is very comprehensive in his answers, so he's covering this very, very well, which is great.
I have one. There's a lot of talk about the startups, how this is going to affect, and there's a lot of startups that are now, that were, they had pre-seed funding in Australia and now they're going offshore. Can you speak to that side of things, Tim? Because there's quite a few in Fireside.
Yes. So they've said there's going to be carve-outs for startups, but we don't know what those carve-outs are going to look like. And at the moment, the issue is they've said we're changing the rules. We don't know what those rules are. There's going to be carve-outs, but we don't know what those carve-outs are. So people in those positions are saying, well, I don't know what's going on down here. We're going somewhere else. Because we've almost got at least 6 months of uncertainty around what the rules will be before we see some legislation. So at the moment, everyone's just sitting on their hands and going, well, yeah, we want to start up a business, but we'll go to somewhere else. Like I think Sam just mentioned, over to New Zealand, which they don't have any capital gains tax. So it's probably a fair call.
Yeah, that's something I've been hearing a lot about as well. Is and actually it's quite surprising, I think, on my socials and worry a lot of the time on socials. I didn't hear much from people who want to invest in homes. I predominantly saw videos of guys who have startups with Albo, in my feed. And I said, I'll meet my new business owner. This guy's taking 47%. He doesn't turn up much, but I'm going to hand over half the business to him.
Yeah, I did see that. And a lot of people are doing it. I think they threatened to sue people about that as well, Albo. So, yeah, interesting things. But, yeah, we've seen the polls. The polls have completely flipped. I think One Nation's in the lead at the moment. And that's just a result of basically they've said something in an election campaign and then done something else and just come out and said, oh, our position has changed. So they said they weren't going to touch negative gearing. They have, and they've asked why. And the answer is my position has changed. Now, can you imagine you do that in any other job or any other sort of sporting club or community centre or anything like that? You'd be, thrown to the wolves. So same thing's happening here, but we've still got 2 years and a lot of water to pass under the bridge before the next election.
Yeah, and 2 years is a very long time.
Yeah.
Absolutely. A lot of people's memories don't go that far, I don't think. So
no. No, don't forget.
Guys, can you we've had two questions come through. Are you guys able to see that, or would you like me to read them out?
Oh yeah, cool. Yeah, I can see it. All right, we'll go with Chris's question first. So, do you think this will stifle entrepreneurship, business ownership in Australia generally? Do you think this has the potential to cause a decline of new small business in the future? It's a great question.
Yeah, I guess, yeah, it is a great question. And it does feel a bit of attack on small businesses. Absolutely. So the capital gains tax change is a huge game changer for small business. And, starting up as well, we typically, a startup needs to reduce the tax as much as possible. That's the goal. Pays least tax as possible because they need to keep every penny and reinvest it in the business, right? So you introduce this minimum tax, which there are workarounds, of course, but the core principle is why are you affecting the small end of town, or your mum and dad businesses, when I don't know, there's so much leakage, so much extra spending. I think we would have heard about the uproar and the way taxes on gas are treated. I think we sell gas and buy it back for more. So just things like that. But yeah, without getting too political, I think there will be a decline of people starting businesses.
Yeah.
Put yourself in your same shoes. Say I'm 40. If I go back to when I was 20, my ambitions was to start an accounting firm. Would I still have that same ambition as a young person now? I'm not sure.
Yeah, I think what is going to create the hesitation there isn't necessarily that it would make the pathway unfeasible, but that there appears to be an attack on that corner of town. And I think that confidence is an enormous piece, which is that people start businesses and they take on that risk when they have confidence to do it based on the broader economy, the government, and the way it's framing it, as well as obviously their own personal circumstance and perhaps the niche that they're going into. But knowing that there's I call it, we keep saying attack, whether that's the right word or not. But when the government's going for small business, it really creates a framing around that, which is that, look, I don't know if I can do it. And yeah, I agree with you. I think that if I was looking at it, I love my business, and you would too if you did it every day. But starting out again would give you hesitation. And that means that there's a lot of people who perhaps aren't as bold as you and I, who may potentially say, oh, I'll stay in my job for another 6 months and I'll see what happens. And I think that's where the impact will be. So there's a question from Adrian as well. So new homes or subdividing property, the newly created dwelling can be negatively geared. Is that right? Won't that increase competition for first home buyers as investors capitalise on the negative gearing benefits there? Doesn't that defeat the whole intent and purpose of what the budget set out to achieve? I think there's a lot of people who are saying that at the moment. And obviously, the impact on rents going up as a result of the lack of investment. There's secondary and third, potential outcomes from this that aren't going to come out until it happens. But what's your take on that one, Tim?
Yeah, we do need investors in the market for people to have the ability to rent in the market. If you look at Melbourne, for an example, there's been an investor exodus in Melbourne and Victoria because of our famous state government. So, there's been all these rental rule changes, basically giving landlord tenants the rights to do basically anything in your house. So there's that, a higher rate of land tax as well. And now there's these federal imposts that will cause more people to sell in Victoria. But yeah, you'll have newer areas, and typically growth in newer areas takes longer than the existing areas because that area needs to get basically developed. You need your infrastructure there, and you need the demand to start exceeding the supply. And there's a lot of supply in newer areas. And it is easier for people to buy in those areas. But now, yeah, I think it's a good point because you're going to have people competing against investors in that space. And it's become hard because to buy a block and build, the building costs are phenomenal, and they keep increasing. So that's hard for people to get into those properties. But now they're going to be competing against investors if that's what they decide to do. So yeah, look, I think for existing properties for the short term, there's there's going to be less demand from investors, but at the end of the day, the existing areas there's lack of supply. So if you think
Mm.
about, Gold Coast, for example, there's a limited supply there, so you're always going to have more demand than supply in an area like that. So yeah, I think for new homeowners competing against investors for new homes, it does make it harder for them for sure. And like with the new rules, is to claim negative gearing on the existing property, you've got to make it into more than than what you buy. So if you buy a property, knock it down, it's got to have at least two properties on there. And if that's an existing area, you're absolutely going to have your investors wanting to buy that property for the negative gearing.
Yeah.
So you think about in Victoria, in a blue chip suburb, a lot of those older houses will get purchased, knocked down, and they'll build townhouses or they'll build a duplex. But now those duplexes and townhouses, the investors are going to want to buy 100%. So it almost, especially in those suburbs where new properties are rare, I almost say new homeowners won't be able to buy those properties because there'd be too much investor demand on them.
Yeah, I absolutely agree with that. Um, yeah, and I think I mean the flip side of this is that there's plenty of investors that don't need a negative gear their properties, which means that there'll still be demand from that corner of the market. But so back to the tax implications. Can you? I mean, we're probably coming to the point where we're going to tie this up. Can you give us a bit of your perspective? You've obviously got quite an established business with a large cohort of clients. What are people coming to you with? What are the sorts of problems that they've got that you help them fix in this arena?
Yeah, so away from the budget, I feel like for the last 2 years, there's been a pinch on people's margins. So the margins are shrinking because their costs are going up, but they haven't been able to pass, for some businesses, pass those costs onto the customers. So which basically means the cost of doing business is more, and the crunch is hitting them. And also in some of those areas, there hasn't been enough work around. So yeah, the margins are getting squeezed, but they're also competing with other people to win the same jobs, and that's sort of the play in Victoria. So yeah, we've got that issue away from the budget, and I think there's a lot more compliance with the tax office as well. So one example is we're just about to run into what's called payday super. So in the past, an employer wouldn't have to pay their super until the quarter's finished. So it'd always be a massive lump sum at the end of the quarter, but they can work towards that, right? Whereas now, you've actually got to pay your super when you pay your employees every week. So more work involved, and it hurts your cash flow.
Yeah.
And things like this constantly change. So yeah, I find all these sort of compliance changes, and now I've got these new tax rules. You've really got to be all over the numbers in your business, and if you're not, uh, you might find a bit of trouble. So in the past, we'd run into clients that 15 years ago would run a good business just because they're good at what they do. Not good at numbers, not good at running the business, just good at what they do. But now you've got to be more than that. Just good at what you do. You've got to be all over your numbers and making sure your margin in space. You're watching your cash, and you're not taking too much money out of the business as well. That can really hurt people.
Yeah, good perspective. Um, So yeah, and any other questions, anybody? Because we're probably coming to a point where we might summarize. And I think we're good. Anything else, Tim? If you were to have a couple of minutes, just to give us your framing of it.
Yeah, look, as I said before, it's yeah, they're just announcements, but it looks like the capital gains and negative gearing is going to go through. Whether or not it ends up getting reversed, time will tell. We saw in New Zealand they scrapped negative gearing, and then 2 years
Yeah,
later they brought it back in because it just created a nightmare for them over there.
yeah.
So
Well,
yeah,
I think that I mean it's quite interesting because with the Ireland government that they obviously there's been a test case that's been rolled out in a neighbouring country nearby, and I think one of the biggest implications from that was the massive hikes in rental prices across say Auckland, for instance, and the impact that that had on people that were potentially going to buy their first home. So hopefully we go through a similar scenario where perhaps if it is rolled out and there's implications that are negative, then it gets rolled back.
I mean, I think it'd be a slower burn here because the existing properties are quarantined. So I think
Yeah.
rents will go up, but it'd be slower. And I just don't think it's going to improve affordability. Obviously, there'd be more tax collected.
Yep. So, if you own a business today, operated through a family trust, which a lot of people do, and you plan to grow and eventually sell that business, what would be a strong piece of advice that you'd give to that person based on what we talked? Hey Tim, that was a really good point that you made there around the bucket company. If you do have a trust, can you just give us a little bit more detail on that? Just how that structure would work and how the money would flow. Yeah, that's really good. Tim, can you just in sort of a layman's perspective, can you spell that one out again from to increase your profit through up until that period of time? Can you just give us a little more on that? That's actually really interesting and quite a powerful point because it shows that I think with the right advice, you can potentially come up with a plan that might touch on a few of the points that we're talking about today. That could build up to be something quite substantial when it comes to your potential tax bill.
Great. Thanks so much, Tim. That was great. That cleared up some questions in my mind. And yeah, really and great job, Bobby. Just brilliant. I'd like to reiterate that if anyone has any questions or any problems that they're facing, that to reach out. We've had several cases in with lads in the group where they've thought that they're in trouble or there wasn't even a solution, and they've reached out and we've been able to provide some sort of solution or advice from one of the panel members. So make sure you do that, lads, and do it quicker rather than be proactive rather than reactive with these things. So yeah, definitely do that. Yeah. We had a case in the group where he was in construction, doing about 40 grand a month. He had a tax debt and he needed equipment, and because of the tax debt, his bank wouldn't give him the funds. But he was able to find an alternative funding solution and went from 40k a month to 80k a month with the new equipment, and then within 3 months or so, he was back in front of his ATO debt. So there's solutions out there. So that's what we're here for, lads. So, whether it's accounting, finance, legal, anything, make sure you get in touch and do it quickly so that you get on the front foot.